June 15, 2008, the day Lehman Brothers announced a staggering $3.9 billion loss, a figure that would become the final tremor before the financial world shattered. It was the moment the most storied investment bank in America, a titan that had once walked the halls of Wall Street with the confidence of a monarch, revealed that its empire was built on sand. The collapse of Lehman Brothers would ignite the worst financial crisis since the Great Depression, sending shockwaves through markets, shuttering homes, and reshaping the global economy forever. Lehman's story began in 1850, when Henry, Emanuel, and Mayer Lehman left their modest mercantile shop in Montgomery, Alabama, and opened a small cotton brokerage in New York City. The firm's early success rode the surge of the post-Civil War cotton boom, and by the turn of the century, Lehman had diversified into securities, railroads, and even early oil ventures. The firm's reputation for shrewd risk-taking and relentless ambition grew with each generation, and by the 1970s, under the leadership of the legendary maverick Dick Fuld, Lehman transformed into a global investment powerhouse. The 1990s and early 2000s marked an era of exponential growth. Lehman's balance sheet ballooned as it underwrote billions in mortgage-backed securities, leveraged buyouts, and complex derivatives. The bank's aggressive expansion was fueled by a relentless pursuit of profit, a corporate culture that glorified taking the biggest deal and rewarded risk with multi-million-dollar bonuses. In 2005, Lehman's assets surpassed $500 billion, and the firm boasted a market value of nearly $30 billion. The world watched as Lehman's name appeared on the front pages of financial magazines, a symbol of American ingenuity and daring. Yet, beneath the glossy press releases, warning signs began to surface. In 2004, senior analysts noted a dramatic increase in the proportion of Lehman's assets tied to subprime mortgages, loans made to borrowers with weak credit histories. The bank's leverage ratio, a measure of how much debt it used to finance its assets, swelled to more than 30-to-1, meaning that for every dollar of equity, Lehman held $30 of borrowed money. Such leverage amplified profits in good times but left the firm dangerously exposed to any dip in the housing market. By 2006, the housing bubble showed its first cracks, home prices plateaued, and default rates on subprime loans began to rise. Internally, a handful of risk managers raised concerns about the growing concentration of Vault A and Vault B mortgage tranches on Lehman's books, but their warnings were dismissed by senior executives who believed the market would recover. In 2007, as the subprime crisis erupted in the United States, Lehman's trading desks reported record losses on mortgage-backed securities, yet the firm continued to double down, purchasing more distressed assets at steep discounts in the hope of a quick rebound. The turning point came in the summer of 2008. On July 7, the U.S. government announced a $700 billion bailout package for the insurance giant AIG, a company whose exposure to similar mortgage derivatives mirrored Lehman's own. The market interpreted the rescue as a sign that Lehman could be next. On September 9, Lehman announced it would sell $22 billion in mortgage assets at a severe discount, a move that sent its stock plummeting by more than 30% in a single day. Investors rushed to pull their money out, and overnight, Lehman's credit lines froze. Negotiations with potential saviors, Bank of America, Barclays, and the Federal Reserve, dragged on for days. The U.S. Treasury, wary of creating a precedent for a massive bailout, offered only limited assistance, insisting that any deal must be private sector driven. On September 15, with liquidity evaporating and counterparties refusing to roll over short-term funding, Lehman filed for Chapter 11 bankruptcy. In less than 24 hours, a $600 billion financial institution vanished, leaving a trail of unpaid debts, frozen assets, and a global market in free fall. The immediate aftermath was catastrophic. Stock markets worldwide tumbled. The Dow Jones Industrial Average plunged 504 points, its largest single-day point drop at the time. Credit markets seized up as banks hoarded cash and refused to lend, fearing that the contagion would spread to their own balance sheets. The U.S. Federal Reserve slashed interest rates to near zero and launched unprecedented emergency lending facilities. Governments across Europe rushed to inject capital into their banks, and the International Monetary Fund began coordinating a global response. Lehman's collapse also exposed deep flaws in the financial system: the perils of excessive leverage, the opacity of over-the-counter derivatives, and the moral hazard of too big to fail. In the United States, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in 2010, imposing stricter capital requirements, mandating the clearing of derivatives through central counterparties, and creating the Consumer Financial Protection Bureau. In Europe, the Basel II framework tightened capital standards and introduced liquidity coverage ratios to prevent banks from relying on short-term funding. For the individuals whose lives were upended, the impact was personal and profound. Thousands of Lehman employees lost their jobs overnight, their retirement savings, often heavily invested in company stock, eroded to near worthlessness. Homeowners faced foreclosures as credit dried up, while pension funds that had counted on stable returns were forced to recalibrate their obligations. The crisis reshaped public trust in the banking sector, fueling movements like Occupy Wall Street and sparking a wave of political debate about regulation versus free markets. In the years since, Lehman's name has become a cautionary shorthand for hubris and systemic risk. Subscribe to The Collapse for more stories like this.